Welcome back. Today we're diving deep into a topic that's been buzzing in the dividend investing world, VDIG, the Vanguard Wellington Dividend Growth ETF. Now, here's the twist. VDIG isn't your typical dividend ETF. Most of the dividend funds out there are passive, meaning they just follow a preset index or a formula, picking stocks based on rules rather than judgment. There's no human decision-making, just algorithms doing the heavy lifting. VDIG, however, is actively managed. That's right. It's run by Wellington Management, the same team behind the Vanguard Dividend Growth Mutual Fund, ticker VDIGX, which has been operating for nearly 20 years. And here's the part that really catches your attention. The mutual fund has around $44 billion assets, making it one of the largest actively managed funds in the country. It even earned Morningstar's gold rating, and its performance during market downturns is downright impressive. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. To give you a perspective, during 2022, when the S&P 500 fell approximately 18%, SCHD dropped about 3.2%. That's already pretty resilient, but VDIGX only declined by 4.9%, landing in the top 2% of all large blend funds that year. And this isn't a one-off. Over 6 major market drops of 20% or more, this strategy has outperformed its large blend peers by an average of 6.6 percentage points. So when Vanguard decided in November 2025 to package this strategy into an ETF, investors really should have paid attention. Now, let's address the big question everyone wants to know. How does VDIG compare to SCHD? Let's start with dividend yield because that's what most income-focused investors look at first. SCHD currently pays a dividend yield of roughly 3.3%, which makes it appealing if you want a steady cash flow. You buy it, get paid, reinvest, repeat. It's simple and satisfying. VDIG, on the other hand, has a starting yield of only about 1%. I know that sounds low and it can be off-putting if you're thinking in terms of immediate income. But here's the crucial point many investors miss. VDIG isn't built to deliver the highest yield today. Its focus is on accelerating the growth of that yield over time. There's a huge difference between high current yield and fast-growing yield over years, and understanding that difference can completely change your strategy. To illustrate, imagine Alex invests $10,000 in SCHD. In the first year, he collects roughly $330 in dividends. Sounds good. Now, Alex's friend invests the same $10,000 in a fund following the VDIGX strategy. Year 1, he only gets about $100 in dividends. Not impressive at first glance. But here's where it gets interesting. If that 1% starting yield grows consistently at a faster pace than the 3.3% yield over 10 years, the total wealth, dividends plus price appreciation, can surpass the higher-yielding SCHD investment. Historically, that's exactly what VDIGX has done. Over the past decade, it has delivered an annualized return of roughly 12.5%, while SCHD returned around 10.9% per year. That 1.6% annual difference, compounded over 10 years, adds up to thousands of dollars, and over 20 or 30 years in a retirement account, the gap can be enormous. Now let's peek inside the funds to understand what's driving these differences. SCHD currently holds about 101 stocks. As of February 2026, the top holdings include Lockheed Martin at 4.8%, Texas Instruments at 4.3%, ConocoPhillips and Chevron both around 4.3%, and Verizon at 4.2%. Looking at the sector breakdown, energy makes up nearly 20%, consumer defensive around 18%, healthcare about 16%, and tech only roughly 10%. VDIG, by contrast, is far more concentrated, holding just 40 stocks. Its allocation is quite different. Technology accounts for roughly 26%, financial services about 24%, healthcare around 13%, consumer cyclical roughly 13%, and, here's the key, energy and utilities are at 0%. That's right, no energy exposure, no utilities. This isn't just a minor tweak, it's a fundamentally different bet on the economy, targeting growth sectors rather than traditional high-yield sectors. So, what does this mean for your portfolio? It comes down to the type of dividend investor you are. If your priority is high current income and exposure to classic value sectors like energy, healthcare, and consumer staples, SCHD is extremely well designed. It has over $84 billion in assets, an incredibly low expense ratio of 0.06%, and has consistently delivered reliable dividends since its 2011 launch. But SCHD isn't perfect. Its heavy tilt toward energy and underweight in tech hurt it in 2025. That year, SCHD returned only 4.3%, while VIG returned about 15% and VYM around 17%. Even in 2023, SCHD only managed a 4.6% return. VDIG, on the other hand, brings a different profile. The mutual fund version VDIGX has shown remarkable defensive qualities. During downturns, it typically declines less than the broader market, sometimes dramatically so. For example, in 2008, VDIGX dropped roughly 25.6%, while the S&P 500 fell nearly 38%. The concentrated, high-conviction approach means the manager selects companies with strong balance sheets, growing dividends, and resilience in economic storms. Think Microsoft, Apple, Broadcom, MasterCard, and Alphabet. Companies that SCHD largely avoids because they don't meet its current yield criteria. Another important factor is turnover. SCHD recently underwent a major 2025 reconstitution, adding 20 stocks and removing 17, and energy exposure jumped over 8 percentage points. This is typical for an index tracking ETF, but every reshuffle brings uncertainty and potential tax implications. VDIG operates differently. Historically, the mutual fund has very low turnover, often under 20%. Managers aim to hold companies for a decade or longer, which reduces taxable events, lowers trading costs, and creates a portfolio that evolves gradually rather than being reshuffled annually based on rigid rules. This can make a real difference in a taxable account and for long-term wealth accumulation. Let's be real about the trade-offs. SCHD, 3.3% yield, 0.06% fees, $84 billion in assets, 14-plus years of ETF history. VDIG, 1% yield, 0.4% fees, only $22 million in assets, and an ETF track record of just 3 months. On paper, SCHD looks safer and cheaper, especially if you value income today. But here's the kicker. VDIG gives you access to a proven 20-year strategy with VDIGX, managed by a highly respected asset management firm. Its historical performance shows stronger total returns and better protection in downturns compared to many large blend funds. It may cost more and start with a lower yield, but it provides long-term growth potential that SCHD cannot match, especially for younger investors with a multi-decade horizon. So what should you do with this information? Here's my framework. If you're near or in retirement and need consistent income, SCHD is a solid choice. Its 3.3% yield is meaningful, the low expense ratio keeps more money in your pocket, and its massive size ensures liquidity. If you're in your 30s or 40s with decades to invest, VDIG deserves serious consideration as a core holding. Its concentrated quality companies, tech exposure, and defensive characteristics can compound powerfully over 20-30 years. The lower initial yield matters less if you're reinvesting everything. Could you own both? Absolutely. SCHD delivers high current income and value sector exposure. VDIG offers quality growth, tech exposure, and downside protection. Together, they complement each other, providing diversification across income, growth, and risk management. Here's the bottom line. VDIG isn't necessarily an SCHD killer. They serve different purposes. SCHD is for today's income. VDIG is for tomorrow's growth. Ignoring VDIG because of its low starting yield would be a mistake. The $44 billion mutual fund behind it has a 2-decade track record of delivering strong total returns, protecting capital during downturns, and outperforming peers. Sometimes the fund that pays less today ends up making you far more tomorrow. That's the magic of dividend growth and compounding over time. For retirement planning, chasing the highest yield isn't always the smartest move. Chasing quality, resilience, and long-term growth often wins. And that's exactly what VDIG brings to the table. A strategy with a proven record, now available to ETF investors for the first time. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.